Good afternoon, everyone, or I guess depending on when you're watching this, could be good morning or good evening. This is Kevin Kernen, and I'm with Brian Beaty, and we'll do some formal introductions. And we actually are sitting right next to each other. Just wasn't able to get the Zoom room quite set up perfectly, but welcome to today's session on real estate valuation methodology and challenges in appraising during a pandemic. So for some of you that have been around CBOR for a while, I have given a similar presentation to this maybe 4 or 5 years ago, where we talked about real estate valuation methodology and went over some case studies. We'll have a similar format today. So hopefully those returning folks have a really bad memory, because you might be bored in the first part of this. Real estate valuation isn't super dynamic in that the appropriate methodology changes. So it'll be a lot of similar things, but hopefully we have some folks that are new to this and are interested in learning more about real estate valuation and to listen on a few case studies that Brian and I have. So sliding over to our next slide here, just again, quick overview. We're going to go over general real estate valuation methodology. We're going to layer in some discussion about how COVID has impacted that and the different valuation approaches, as well as just generally, scope of work discussions and things like that. And then we'll jump into a couple of different case studies, one on hotel valuation, which, as I'm sure many of you know, is significantly impacted by COVID and some of the changes to the economy. And then we're going to talk a little bit about cannabis valuation matter, which less of COVID specific language, but we thought that would be something that folks would be interested in. So high level, to start out with some general introductions. Again, my name is Kevin Kernen. I'm a managing director with the firm Stout. I help co-lead our real estate valuation practice. I specialize in all commercial real estate valuation, essentially anything except for single family residential. On a rare occasion, we will get involved in some single family residential, but really the main focus is on commercial properties. And for the most part, my area expertise is on the litigation front. So I do a lot of work related to expert testimony. So anytime there's a dispute over commercial real estate values, folks like me get brought in to do the valuation and then testify to those findings. So that's really where I spend most of my time. And I'll turn it over to Brian to give an introduction of himself.
Thanks, Kevin. As you said, my name is Brian Beaty. I am a vice president with CBRE. I work also in the valuation advisory services department, specializing in litigation as well. Kevin and I used to work together, which is one reason why we decided to do this together. CBRE is one of the world's largest commercial real estate services and investment firms. We have 100,000 employees worldwide and 530 offices. You name it, we do it. I started my career more than 20 years ago as an appraiser in Los Angeles. Earned my MAI designation 7 years after beginning, which I thought was pretty quick. Throughout my career, I've appraised nearly every property type like Kevin. I've done a lot of specialty, especially for litigation. I have done subway tunnel easement valuations. I've appraised mountaintop communication facilities, appraised portions of property for eminent domain. I've been focusing on marinas, wineries, and marijuana dispensaries here in Michigan. Other things that we do that are outside of the typical valuation realm are studies. Impact studies are very common. We did an appraisal just to determine the effect of a proposed gravel mine on surrounding residential properties. I've done a similar study to determine the effect of a proposed hospital on surrounding residential values. And then also, this was an interesting one, I determined what the market rent should be for sidewalk space for eateries that in Southern California.
So that's a quick intro on Brian and myself. As Brian indicated, we both worked on a wide variety of projects. And as he said, we go back quite a few years. We worked together, I mean, it was probably close to 15 years ago or so. So, definitely it was fun getting back together to do this and share some stories about what we're working on. And hopefully we can share some of those with you all today and some of the knowledge that we've picked up over the years. So then jumping in. So really just to start, as I mentioned, real estate valuation methodology. I wish we were doing this in person or at least had an audience where we could do some Q&A. Definitely makes things flow a little bit easier or more efficiently. But we'll do our best to keep this moving along and keep it interesting for you all. So just jumping in, and so just a high level of what it's like to work with a real estate valuation person and some general just tips and just give general understanding. Every project starts with that scope of work discussion of why are you hiring that appraiser to do work and what are the specific parameters of that project. So there's a lot of factors that go into this, and you can see and read many of them for yourself on the page. I won't go through them all, but just generally speaking, this is a collaborative piece of the engagement where the appraiser needs to understand, okay, first off, why do you need this valuation? What is the purpose of getting the valuation done? Is it a litigation matter? Is it estate tax purposes? Is it a financing matter? There's numerous different reasons why someone would need a real estate valuation. And so that's an important factor, obviously, for the appraiser to know. Understanding the appropriate premise of value. Depending on the purpose of the appraisal, there could be a different premise of value. A lot of them are market value or fair market value based, very similar from a definitional standpoint, but you might have an insurable value for insurance placement purposes, which that valuation looks a lot different than a fair market value valuation. So it's really important to understand the appropriate premise of value, particularly when you're working in like a litigation context and you have different venues. Property tax, they have different definitions of value by state. So it's really important to understand, for the appraiser to understand exactly the correct premise of value and what definition to use, because that could really impact how the valuation is undertaken. There's also property rights to consider. Are there tenants with leases in place that need to be considered? Are you looking at an owner-occupied property? Are you looking at a situation where you're appraising a building that's on leased land? So it's just important to understand the ownership rights associated with the property being valued. Obviously, the written document that the appraiser is going to put together. You can have more of a letter type document, or you can have a full appraisal report. So that's something that obviously is going to impact timing, fees, what that deliverable is going to look like. All of those things will play into that. The next one is, here's an example of something where COVID has had a pretty significant impact, is whether or not an inspection is completed. Now, I think we're generally through that phase right now, and hopefully won't go back to this being a big issue, but obviously getting access to properties and what are the rules for being able to get in and get through, and can we even get in to do an inspection? And so you'll really want to talk through that with the appraiser to understand, okay, if we can't do an inspection, what does that mean for the reliability of the valuation? What does it mean for information needed? A lot of times an inspection isn't a critical piece of the valuation if the appraiser is able to get all of the information that they need to understand the physical improvements that are in place. So whether it's interior and exterior photographs, having a property contact fill out a questionnaire about the history of the property and the condition and some of the capital improvements that have been done. We had a sort of an extreme example in my group where one of my colleagues was working on a regional mall, and one of the owners went through the property, essentially FaceTime their way through so that the appraiser could do the inspection. And that was the best we could do at the time, because it was when it was most restrictive in terms of COVID related restrictions. So excuse me. So yeah, that's certainly an area that COVID and pandemic has played a role within the scope of work process. Next step I sort of alluded to is the information collection process, understanding what information the appraiser needs and what's important to do for them to complete a reliable valuation. And certainly this is a critical area. And we, we recognize that sometimes the information request you get from appraisers can look pretty cumbersome. But, we always try to keep that as concise as possible. And I can tell you there's nothing more frustrating from an appraiser's perspective if all of a sudden you deliver your report and this piece of information pops up because they didn't like your number or what have you. And all of a sudden this information shows up that you asked for at the beginning of the project. So, share everything with your appraiser. That's just the way that they're going to be able to put together a reliable determination of what the value is of your property. And so that's a critical piece to the scope of work process, is understanding that information that the appraiser needs to do their job. And then you can talk about more just, appropriate approaches to value. Obviously, that's an appraiser's main job to determine that, but that is something, obviously, if you have a sophisticated client, they're going to understand and they can talk through the strengths and weaknesses of each approach so that you understand how the appraiser is looking at it. And then to the extent that there's extraordinary assumptions that need to be made or hypothetical conditions that need to be applied in the valuation, those are things that need to be talked about as well with your appraiser at the onset of the engagement. So a lot of different factors to cover, but again, this is a key piece of the process in making sure that the appraiser understands, the exact marching orders in terms of, again, what they need to do and applying the right approaches and the right valuation for the appraisal problem that's at hand. So moving on from there, we jump into really one of the, outside of the data collection process, when you really start getting into your analysis process. Most fair market value or market value premise is based on evaluation to the highest and best use of the property. And I'm sure a lot of you are familiar with this concept, but we'll walk through it here briefly in terms of what we mean by highest and best use. And there's quite a bit going on here on the page, and so I'll try to streamline it for you. But essentially, we go through 4 different tests of determining what the highest and best use is for a property. And as the diagram on the bottom shows, it's a little bit, like a funnel where we narrow down the types of uses down to whatever that ultimate highest and best use for the property is. So the first thing we're doing when we're looking at a property is, what are the legally permissible uses? So what, from a zoning perspective, can we do on this site? Are there any easements in place? Or are there any other use restrictions in place that carry with the property that the next purchaser would have to abide by? So, you can eliminate a lot of different property types from that analysis. Then once you have all of your legally permissible uses, you'll go through a process of determining, okay, which types of uses are physically possible. And, that might not narrow down your list at all, but in some cases it does, because maybe you don't have enough, the size isn't adequate for enough parking for certain uses. The topography, the soil conditions don't support a certain size of property or limits the size of the property. There's a lot of different physical limitations that could impact the type of use that goes on that property. And then once you've narrowed that down, you get to which uses are financially feasible. So which uses are going to create or result in a positive return after, if we're looking at a vacant site. So after you consider, construction costs and lease up process, which of those uses are you going to still have a positive value from? And that'll typically cut down a significant number of those uses to a few. In this case here, in this diagram, as you can see, it's sort of narrowed it down to an office use or a medical office use. And then lastly, you take all of those and essentially figure out which of those is going to be maximally productive or ultimately result in the highest value. And that is going to be the highest and best use of the property. So that's the type of use that a prudent investor is going to put that property to. And that's the type of use that, from a market value perspective, you're going to look for those comps in your valuation process. So that's really the highest and best use process in a nutshell. And I'm sure you can figure out, if you get that wrong, you're going to have the entire valuation wrong. So it is absolutely a critical piece of the overall valuation process. And yeah, you might as well not even do the approaches if you get this wrong, because the value is just going to be completely off base. So really, really critical piece of any valuation project. So once you've determined your highest and best use, now it's time to apply or consider the application of the three primary approaches to value. And so we have the sales comparison approach, an income capitalization approach, and a cost approach. And I'm going to go through the sales comparison approach here, and I'm going to turn over to Brian to go over the income approach and the cost approach. I get the easy one. So sales comparison approach in a nutshell is the one that I think everyone is familiar with, or most everyone is familiar with, of I'm looking at other properties that are similar to mine, seeing what they sold for, and using that as a basis for coming up with what the value of my property is. I'll go through some of the strengths and weaknesses of the approach, as well as some COVID considerations that we've dealt with here over the past year and a half. Strengths, obviously it's easy to understand. I think everyone, when you're talking to any real estate professional, any non-real estate professional, it's a pretty easy concept to explain, and explain why it provides a meaningful result. Almost everyone's gotten their home appraised at some point and has seen at least a residential appraisal. Commercial appraisals are very similar in terms of process, but that is certainly one of the strengths of a sales comparison approach is the reader is going to be able to follow what's done and understand conceptually the valuation approach. When the market is strong, usually information is plentiful. So there's lots of sale transactions out there, easy to find, or at least easier to find, sales of properties similar to yours in your market that you can compare to the subject in determining a value. So that's certainly one of the strengths of the sales approach. And then lastly, I sort of mentioned this earlier, but it's what market participants are doing as well. What I like to tell folks when I'm explaining the valuation process, or what my role is in the process of coming up with an independent determination of value, I really need to or want to mimic what investors in the market are doing. And so if investors in the market for whatever property type I'm appraising look at the sales comparison approach, then that's something that should be important to me in doing my work. And in a lot of cases, it is a sales comparison approach that they're looking at. They're looking at what other people are paying in the market for similar types of properties, and using that as a basis for whatever number they're comfortable either buying or selling their property at. So those are some of the strengths of a sales approach. Now there are also some weaknesses. One, give it, for certain property types, and we're going to talk about one here a little bit later in hotels. It can be challenging for the adjustment process. So we're making adjustments for similarities and differences in physical and locational factors. And those can be tough to quantify when you're looking at golf courses and hotels and some more special purpose type properties, where it's not conceptually easy adjustment process of building size or land to building ratio or things like that. Income is really the driver in hotels and golf courses. And so going through, if you're familiar with a sales comparison approach adjustment grid, that can be really challenging for those property types. In a lot of cases, hotels, you won't even go through a full adjustment process. You'll just look at sales, put them together in a summary table, sort of see what that tells you from a sale price, looking at the array of sale prices, but you don't even attempt to try to do an adjustment process because each property is just so unique. If you have inactive markets, which is something we've had to deal with COVID, and definitely dealt with in the Great Recession, if you don't have a lot of sales, obviously you don't have great information to rely upon it. So you might have to go further back in time to find sales than you normally would like to, or geographically, you might have to go broader. And those are all going to make it a little bit more challenging to apply a sales comparison approach. You want property sales as recent as possible, and as close to your property as possible. Obviously, you can adjust for those factors, and there are cases when you can adequately adjust for them. But ideal world, you have sales are plentiful, and you can really key in on ones that are very similar to your property. And then lastly, there's the concept of paired sales, where you have a sale of a property, a comparable property, and it's exactly the same in all features except for one. So you can easily narrow in on what that difference is. Everything's the same with these two properties, except one's, I don't know, 10 years newer than the other. And you can really key in on, okay, what was the difference in condition for that property? And all of the difference in the price was based on the condition, because that's the only factor that's different. And then you can really hone in on what an appropriate condition adjustment would be, or age adjustment. Those sales just don't exist very often in the market. Yeah, exactly, right? I mean, it's like this thing that's out there that they always tell us about in the classes, but you never actually find one. It's the unicorn, right? So paired sales are really challenging to find. So you have to use a lot of professional judgment in talking to market participants, relying on your past experiences. A lot of times, in terms of quantitative adjustments, you'll see them done in percentages. So what makes an adjustment right at 5%, but wrong at 4%? Probably nothing. So, there's certainly, that professional judgment factor, which, can be a weakness in that approach. And lastly, COVID considerations. What are some of the things that have occurred here in the last 18 months that we've had to deal with in applying an appropriate sales comparison approach? I had mentioned before, transaction activity has slowed or did slow for a period of time. Obviously, an extremely strong market in a lot of areas. But shortly after the onset, there certainly was, while we didn't necessarily see this big drop in values or anything like that, just the level of activity slowed down and people stayed on the sidelines a little bit. So, not as many sales in certain markets or for certain property types. Another factor is obviously a sales comparison approach is backward looking. You're looking at sales that occurred in the past, and you want them as close to your valuation date as possible, but it is still historical data. And so, when you're dealing with a market where there's some uncertainty going forward in the upcoming months, that can be something that you need to make sure you have a good understanding on of what exactly do your sale comp prices mean, and what were the considerations when the buyer and seller came to a meeting of the minds on those properties. And again, that sort of leads right into the next point of how do you capture or quantify that future uncertainty in a sales comparison approach when all of your data is backward looking. We will look at active listings. They tell us something. Obviously, that's not a completed transaction, but it is a market data point to consider. So I know in a lot of the valuations I do, we will have 1 or 2 listings in there as well, just as another data point that's relevant to the market. And so how does all this play in? I'll go through this fairly quickly, but in terms of the application of a sales comparison approach, as appraisers, we all have access to a pool of databases. Brokers are the same. Obviously, I think most of us are subscribing to CoStar. A lot of firms have their own internal databases. You obviously have your professional network, and we come up with a pool of comparables, and we sort of set out what the criteria is, in terms of use, what kind of size range are we looking at, or age range. And once we apply those parameters, we come up with a pool of potential comparables. We'll narrow those down to the ones that we think are most meaningful. We'll want to confirm the information because, obviously the databases that we're subscribing to are a great start, but we also want to confirm with public records. In ideal world, you're talking to someone involved in the transaction that can really give you a little bit more insight as to what happened in that transaction, what were the key considerations. You choose an appropriate unit of comparison, and a lot of cases it's price per square foot, but if you're looking at apartments, it might be price per unit, or student housing, price per bed. And so you put all of your sale comparables on a per unit basis. You make your physical and locational adjustments, which I talked to a little bit earlier. That leaves you with an adjusted sale price range of your comparables, and from there you reconcile to what your value is from that approach. A lot of cases it's a point estimate of X dollars per square foot, but we're certainly not required as appraisers to opine on one single point of value. You can certainly opine on a range of value. So that's something that you see on occasion as well. So that's the sales approach in a nutshell. And now I'm going to pass it over to Brian to talk about the income approach.
All right. So the income approach is most applicable to properties that are leased, whether single tenant or multi-tenants. The value is based on the income stream that it's generating. It's really, as I said, it's really applicable for income producing properties. Kevin and I were talking earlier that I had a reviewer asking me why I didn't use any leased or fee simple sales for a leased property. And I said, well, it's because there's different buyers are looking at something generating an income stream than they are if they want to put their own business in there. Oftentimes market participants, sophisticated buyers really are the ones looking at this approach. And as Kevin mentioned, we try to mimic what the market is doing. What approach they base on is what we base it on. So as I said, we try to do that. Anytime it's a leased property, we would probably rely on this approach more than the others. Weaknesses of this approach is in owner-occupied markets, there's very little data. If I do a lot of work up north, and in the UP or northern Michigan, there's very few leased properties. It's mostly owner-occupied. So generating rental rates is very difficult, and then also capitalization rates to convert the value of the income into a value, they're difficult to find as well. Another problem with this approach is it's very sensitive to the inputs. A minor change in the rental rate or the cap rate or the vacancy rate can have a dramatic effect on the overall value. So it's only good when you have very good data for the market rent and for the cap rate. Considerations for COVID. Let me step back. In the income approach, there are two basic income approach techniques. There is the direct cap, which was what we mostly do for single tenant properties and maybe 2 or 3 tenant properties. Once you get into large office buildings where you have tenants with varying lease terms, different lease rates, different expense reimbursement structures, then we use what we call a discounted cash flow approach. And that is very useful to project exactly what's going to happen. Well, with COVID, there has been some fluctuations in rent. There's been some tenants have been given free rent during the pandemic, not asked to pay it back. So the discounted cash flow approach is actually useful because we can account for those rent abatements. We can also account for, I know the rent was supposed to increase, but it doesn't look like the market's going to increase rent for a year or two in some cases. So that's a very useful tool for COVID.
Yeah, it was certainly not to jump in on you, Brian, but I mean, that was certainly something that we, right at the onset, so I'm going back a little ways, but, at the onset of COVID, that, we spent a lot of time, and I'm sure you folks did as well, just talking to our clients who are large investors, whether it's REITs or institutional investors, of how are you seeing the world here and what are you projecting? And it was fairly consistent in that, it was more of a blip in cash flows. We didn't necessarily see a huge impact to discount rates or cap rates. Some markets you did a little bit, but really it was okay. Our credit loss we expect to go up for the next 12 or 18 months, or like you said, rent is going to not. We originally had it projecting an increase. Now we're going to say it's going to be stable for the next 18 months. It really was a cash flow, like a short-term cash flow projection crunch is really the message we were getting.
Yeah, we did something similar. We're a national firm, so we had all of our appraisers reach out to market participants, and that was basically the essence of it. There might be a small decrease in cash flow, but Nobody anticipated capitalization rates changing. Nobody anticipated discount rates changing. It was really just, let's not raise the rent for a year. Let's not, evict the tenant if they're not paying because they're a good tenant otherwise. So in terms of the application of the approach, again, collecting market data is the first step. This is one of the hardest parts of the income approach. Where the sales comparison approach, in most states and in Michigan, it's public information. So you can at least find out what the purchase price was from the assessor. Rental rates are not. So that is it's oftentimes difficult to process. And we get a lot of our information from our appraiser network, other properties that we've appraised. We try to keep the tenant confidential, but that is typically where we get our rent comparables. Cap rate comparables are reported by CoStar. And then just like in the sales comparison approach, it's best to confirm that with one of the parties to the transaction, whether it's seller, buyer, or one of the brokers. So we take all that information and we project how much income it's going to create. We look at the market occupancy. If everything is 95% occupied or 98% occupied, say industrial, then we apply, a minor 2% reduction in the potential income to account for that. And that's because even though we're looking at a snapshot, the value is into perpetuity. So there's going to be some time where that property is not occupied. We then project expenses. Ideally, we have a history of the subject expenses, and we can take a look and try to trend those forward. I do a lot of marinas. I always ask for at least 3 years of expenses, and that way, if there's a clear trend over 3 years, then I will continue that trend up or down. Same thing if they're random, then I will typically just take an average, or if two are very close, that's probably the most likely expense. Otherwise, we also look at comparable properties in which we're privy to the operating expenses, and we compare that to the subject expenses just to make sure they're in line and they're not paying an exorbitant salary to the manager or something like that. Capitalization rate, we do it in a number of different ways. The best source of cap rates is through comparable sales. We also talk to market participants. Those two we weight most heavily. And then there's published surveys, and there are some different techniques to try to determine what a cap rate should be. But like I said, the comparable sales and the market participant interviews are by far the greatest weighted. And that's really it on the income approach.
Yeah. I mean, we're sort of simplifying these approaches down for the presentation. I mean, the income approach is I feel like by far the most challenging to appropriately apply, because there's a lot of inputs to it. It can be, depending on the size of the property, number of tenants you're dealing with, it's just can be really complex. And so it's very critical that the appraiser has good information, has the understanding and know how to do it appropriately, because I enjoy most working through income approaches, but they are certainly can be extremely challenging too.
I'm probably a nerd, but I always get excited when you put in that cap rate and you see what the value is.
Yep, for sure. Now the boring approach.
All right. The cost approach is based on basically a reproduction cost of it. Rather than buying this building right here on this piece of land, could you save any money by buying the piece of land next to it and building the exact same building? So we don't use this approach very often. The biggest part is, it's not quite as bad as a used car, but there is significant depreciation that occurs once a building is completed. We typically use it only for buildings that are, 3 years newer or less. And then the other time we often use these is for special use properties, whether it's a church, because churches, although in Detroit they've been selling recently, but churches typically don't sell as openly as other property types. It's a relatively easy approach to understand. As I said, it's how much will, if I buy that piece of property and build that same building, what's it worth? What's it going to cost me? Weaknesses of this approach, however, as I alluded to, depreciation is often difficult to quantify. In Detroit here, we have 100-year-old buildings. Well, Marshall Valuation Service says that, the estimated life is 45 years. Well, does that mean the value is 0? No. So it is very subjective, and it's really the reason we don't use this approach more often. Other forms of obsolescence are difficult to quantify as well. Economic obsolescence, meaning rents don't justify the cost to build it, and then functional obsolescence, where, if somebody builds a 40-foot tall warehouse in an area where everything is 20 feet, there's a lot of cost involved that is not going to contribute value. COVID concerns. Unless market depreciation is utilized, it's not really based on recent transaction activity. The cost manuals, as we typically use Marshall Valuation Service, we get a monthly update of their costs, but I think there's a little bit of lag time from interviews of their market participants as well. I know that we just went through a, construction, lumber especially, was extremely expensive the last year or so. We just got notice through our company that it looks like lumber prices are going down. And so I'm going to probably watch Marshall Valuation to see if they're starting to go up, because as I said, there is a bit of a lag with them. And then some markets, there's just limited information. If there's few land sales, then that's difficult to do the cost approach, because that's the base of it. In terms of application, I kind of covered all this already, but try to find comparable land sales in the area, figure out what the subject site is worth. Then we estimate how much it costs to build that building new, as well as the cost to put in the paving, all of the infrastructure. One thing we didn't talk about is the entrepreneurial incentive. If I'm going to go through this whole process and the value is going to be the same as the building next door, well, then I'm not going to go through the process. I got to be paid for my time to do this. And that's what the profit or entrepreneurial incentive is. Depreciation is estimated, as we talked about. It's the most common is the age life. If it's a 20-year-old building and it's expected to be it lasts 40 years, then 50% of the value is gone. So we will then apply that, deduct it from the cost of the property, add it all together, and we come up with the value of the cost approach.
Enough.
But not used. All right, so in reconciliation, Kevin and I talked about the people that primarily use each approach. That is the basis of our reconciliation. If the property is owner occupied, and we have a lot of quality sales of owner occupied buildings, then we're going to put primary reliance on that. If it is an income producing property, We go through that whole process, and we rely on that approach. And then if it's a special use property or new property, we will use the cost approach, but unless it's a special use property, I can't think of a single occasion when I put primary reliance on the cost approach. So it comes down to what type of buyer is investing in this property, and then the quality of the data that you're able to secure during the process.
One thing we were talking about ahead of time as we were prepping for this is just, you know, in the reconciliation, some appraisers like to use a formulaic approach where they still go through that entire thought process, but then they actually do some sort of calculation of, you know, 80% to this approach and 15 to this one and 5 to this one. Some appraisers, and this is what I typically do, is more just look at the conclusions from each and determine what your opinion is of the value from those three, not so much formulaic. There's not a right or wrong as long as you're going through the right considerations and you know, thinking through it and you know, as long as the process is there, how you actually get to your final opinion. I think there's different ways of getting there.
Yeah, I mean, some people call appraisal an art, some look at it as a science. I'm more of the art. It's before I come up with my final value conclusion, I kind of take a step back, look at the property and say, is that $1 million property? No. So the cost approach is probably not relevant here.
Yeah, I know one of our former colleagues, Dan Tomlinson, who you know, I learned a ton from as I was getting into the business. He used to always say that the fourth approach was the curbside approach of
Yep.
taking a step back. It's like, okay, does this make sense? Do these approaches make sense? Does my final value make sense? I know I've gone through this, you know, in-depth process, but put myself in the shoes of a buyer or a seller. Okay, does that number seem to be reasonable to me? You know, because there's certainly a level of just, again, the professional judgment, common sense that goes into this process.
And in the end, an appraisal is an opinion of value. So there is, I don't want to say there's no right or wrong answers, because there are some wrong ones, but there can be many right ones as well.
All right. So hopefully we didn't bore you with methodology. I know listening to appraisers talk about appraisal is not the most exciting thing in the world, but hopefully, you know, you're able to pick up a few points there as we went through that. And now we're going to jump into a couple of quick case studies. We're not going to get really into the weeds, but we want to talk high level about what we did. Were there any COVID implications to it? And sort of just sort of walking you through in our shoes what our mindset was as we went through this process. We had talked before that you know, obviously hotels is a property type that you know, one of the ones that had the biggest impact from the impacts of COVID. And so again, it still was very similar, and I'll get into this a little bit of, it's more of a, you know, it was more of a, I guess, short-term blip, you know, now a little bit more severe of a blip than some other property types. But it wasn't like fundamentally anyone felt like this industry or this property type was going to be significantly different on the other side of this. So just walking through an example of a hotel valuation, and here's some, you know, a bunch of data that you probably don't care about, but from a high level, if we're looking at, you know, November 2020, so we're, you know, a decent amount into COVID, you know, we're starting to learn some things, understand how it's impacting the market. But from a hotel valuation, the hard part at that point in time, if you put yourself in your shoes back then, is you know, we've been through the summer, the numbers had started declining, people were feeling a little, you know, they're actually feeling pretty cooped up, and you started to see some things open up. But then you get into the fall and numbers started spiking again, a lot more uncertainty sets in, and obviously that's you know, extremely bad for the hotel industry. And so it was certainly a challenging time where they had a little bit of optimism there right before November timeframe, but things were starting to turn the other direction as we got further into the fall of 2020. For this hotel specifically, it was a market leader. It was fairly newly constructed, you know, within the last 5 years or so. Just market leader in terms of occupancy, ADR, somewhat limited competition given where it was at. So they had a really strong position in the market. They had a national flag attached to them. And so a lot of things going their way, and then COVID hits. And so, the only sort of, twinge of negative out there is they knew that there were multiple new hotels in the pipeline. And so they knew that they weren't going to have quite as advantageous of a position in the next 2 or 3 years as more competition came into the space. And that's sort of the reality of, someone's first to market, takes advantage of it, and then they fall back to normal when everyone else catches up. So that is sort of where this one was at in that process. So just from a high level history, as you can see, 2017 to 2019, extremely steady. When you look at it, I know there's a whole bunch of data going on here, but some of the key factors are, you look at occupancy, so row 4 on the bottom chart, they're running along in the mid 80s. You look at their average daily rate into the low 200s, which is extremely strong. And then 2020 hits. And so you can see just annualized revenue just fell through the floor. Occupancy drops into the mid 50s. Lots of uncertainty. So it's very tough time. We talked about the challenges with applying an income approach. Hotel valuation is very heavily dependent on an income approach. And you're sort of stepping in the shoes of an investor in November 2020, and you have this backdrop. How do you approach that? Obviously, a key factor is looking at what the subject has done, talking to the operators. In this case, we're dealing with a very sophisticated operator, so lots of good information. What we always tell folks is, in the 30 days, 60 days, whatever that we're working on an appraisal, we will never get to know your property as well as you know it. And so really leveraging a sophisticated operator's knowledge on their property, what their expectations are, and then layering in what you're seeing from the market participants you're talking to, is how you try to gain some certainty in a very uncertain time. So the next step was really from, okay, well, what was the market doing outside of the subject? And here's just a couple of charts I pulled from our market analysis. There's a lot more that goes into it, but here's a couple that sort of stood out. Obviously, you see here from an occupancy standpoint, the floor fell out. From an ADR perspective, doesn't quite look as steep. Might be a little bit the format of the chart, but obviously there's a pretty decent downturn in average daily rate as well. And then what was the industry thinking going forward? As you can see, everything dropped off, sharp decline 2020. And then, our general consensus when talking to our client as well as other folks in the industry, a lot of people were thinking 2023-ish, things would generally try to get back to at least close to normal. And so here's one chart that we found that does sort of follow that path as well. So, relatively steep recovery. We're not talking a year, but in a few years' time, it's getting back close to that 100% level. And so that was something that we considered. Again, sorry, there's quite a bit going on here, and I'll sort of point to the key of, okay, now what did we do? And really, you can sort of look at the ADR and occupancy. Those are, certainly sort of the key factors. And you can look at, bottom left chart. So our historical average daily rate, as you can see, it certainly was outperforming the competitive set by a wide margin. And then obviously they both dropped off in 2020. And so what did we do? You can see our projections of ADR on the right, and then also on the top chart, row 4, you can see what we did with occupancy. Had it started to ramp back up, stabilize around 2023. And then we actually had to drop off some before just sort of a nominal increase going forward, because the issue here was not only getting back to normal, but when we did get back to normal, and I'll jump on some of these points here, when we did get back to normal, you had a lot more competition in the market, or projected to be in the market. Now, some of those could have fell out of the pipeline with what was going on with COVID, the ones that are earlier on in the process. But there were some that were far enough along, that, we're fairly confident those are still going to happen. Again, COVID, this isn't definitely not, and you can see in my last bullet point, I mean, this wasn't Great Recession 2.0, just very different dynamics. Everyone you talk to in the industry is, it's just a totally different feel. Now, some current concern was going to be when we're sitting there in March, but I think we quickly realized that wasn't going to be the case. And so, things were going to recover. So stuff was going to stay in the pipeline, and there is still going to be new construction. And so, the way we handle it is this one's going to, recover, and we're projecting around 2023 of being stabilized, but not quite to the levels prior to COVID. And the main reason is more so the competition side of it as compared to, anything fundamentally changing in the overall market. It's just the part of the life cycle this property was in. So had a couple of different issues going on at the same time with this one. It was a very interesting project. And as Brian said, there's probably more than one right answer on this one. There's a range of reasonableness, and we felt pretty comfortable that we were in there, just given the data we had to work with, and the folks that we were able to talk to and really get our arms around. But yeah, this was one that was when I was thinking back of what's a good example to talk about here today, and something where it was impacted by COVID. This one certainly jumped to mind as a good project. So with that, I'm going to turn over to Brian. He's going to talk a little bit about some cannabis project. Maybe not quite as much COVID impact, but I'll pass it off to you to give the details there.
As a matter of fact, since our governor allowed cannabis sales during the pandemic, it is almost anti-pandemic. Just to give you a little background, as you know, recreational marijuana has been around since about 2012. It was Washington and Colorado were the first states to allow it recreational. Michigan joined the party, so to speak. In December 19th is when you can first buy here. I believe we were the 10th state and the first in the Midwest to legalize it. Right now, as of at least June, there were 19 states plus the District of Columbia that allow recreational use, and then there are additional 15 states that allow sales for medical use only. I actually found this really interesting. As I said, I do a lot of dispensaries, which has become is growing and growing. In 2018, there was approximately $9 billion of legal sales, emphasize legal. By 2024, that amount is expected to increase to 31 billion. Marijuana use being a $30 billion industry is mind-blowing to me. But and that's a 240% increase. In Michigan, it's not quite as dramatic because we had medical sales allowed prior to 2018. But in 2018, there was $632 million worth of sales. That amount is supposed to increase nearly 100% to 1.25 billion by 2024. Some of the issues here, legal ambiguity. It's a threat to cannabis. As we all know, it's legal here in Michigan, but it's a Schedule I controlled substance under the Federal Controlled Substances Act. This creates challenges for cannabis operators, especially when they're trying to get financing. As most banks are regulated by federal law, I had one assignment where the bank actually, it was a leased property. The bank wanted me to give a hypothetical condition, a value based on a hypothetical condition that it's actually legal federally, which, and as I don't know if you guys know, but banks typically cannot lend on hypothetical conditions. So it was a very unique circumstance that they wanted that. Although I jump down to the last paragraph, as this industry grows, and it is definitely growing, State governments are going to depend on the tax revenue. There's going to be some pressure from the states to the federal government to legalize this, and we believe that this is going to happen sooner rather than later. So getting into the property that I did, this was a dispensary located in the western part of Michigan. For obvious reasons, I'm being discreet, for confidentiality reasons, I should say. One mind-baffling aspect of these dispensaries is the rents that the tenants are paying. They are typically anywhere from 2 to 6 times what market rent is in that area. Based on discussions with companies that are developing in the market, it really has to do with the few number of sites that can actually accommodate their use. We're talking only 19 states plus DC that allow recreational sales. Within those states, some cities have opted out of it, and within the cities that have actually opted in, you have to be 500 feet from a school, from a church, from anywhere else.
So so when you say market rent, we're talking a retail building. So it's, if someone were going there to sell clothes, they're going to pay X. Exact same building, it's going to go for Y, which is materially higher.
Correct.
Okay.
Part of that is the increased cost of security and alarms and video surveillance. However, from what we can tell, it's mostly a location factor that determines that high rent. The problem with that, and as I said before, we believe that it's going to become legal federally soon. In this case, it was a 4,000 square foot approximately building. They were paying about $55 a square foot, whereas a building down the street, similarly constructed, was about $17.50 a square foot. So the appraisal problem was to try to determine what the value of this property was, given the changing environment of cannabis. So rather than capitalize the $55 rent, which would have inflated the value significantly, the way we looked at it is this is a temporary situation for the initial term of the lease, and this lease was 10 years. So what the chart there basically shows you the difference between what a normal tenant would pay and what the cannabis company is paying, and then we add those all up, come up with a present value. So we discount that, and that basically that's a discount factor is like a level of risk. When you're paying 4 or 5 times the amount of what other people are paying, there's a significant level of risk that tenant, if their operation isn't going well, they'll just walk away from their rent, and then the landlord will be out nothing. So we discounted at 20%. In this situation, the whole what we call the present value of the non-market rent or above market rent came out to be $700,000. And if you want to flip to the next slide, in this particular case, that doubled our value. the value of the fee simple was about 700, and then this added another 700. But the reason we did it this way is I feel that we avoided overvaluing the property, because if we would have capped a rent that even at a higher cap rate, if we would have capped that quadruple the rent or triple the rent, it would have been overvalued in my opinion. And then, as I alluded to, federally regulated banks can't consider the contract rent, but this has been accepted by many of them as we're not really capturing. Yeah, we're giving credit to the contract rent, but not fully.
Yeah, I mean, this is one of those that when when Brian was explaining this to me, when we were doing some planning for this presentation, it made total sense to me. Like, and this goes back to sort of the common sense approach of, you could have simply just threw a direct cap at it at the contract rents, came up with a number and said, that's it. And it just, this logically makes a ton of sense how you approached it. And that's why it's just critical to be working with a valuation professional that knows what they're doing, can think through this type, and can give you a reliable indication of value that's not too high or too low. Ultimately our job is to come up with an independent, determination of what our opinion of value is. And so, I thought Brian did a fantastic job with that. It made a lot of sense for me. Someone that I haven't done these, I've done some grow warehouses, but I haven't done really anything in the dispensary space, and just made a lot of sense. So well done. So that's it from our end. So I guess just to close in brief, we really want to thank the folks at the CBOR, Nancy and just asking us to put this presentation on. Hopefully you all enjoyed it and got a little bit out of it. And anything that any questions we can answer. Obviously we can't do Q&A here as we're sitting in my conference room recording this, but feel free to reach out to either of us, and we'd be happy to have a discussion with you. If there's anything on the presentation we can handle, or anything you're dealing with in your business, definitely give us a call.
If you have any appraisal needs, contact Kevin or I. We're happy to help you.
There you go. Thanks a lot. We appreciate it.